So another year and another budget handed down. This year, the budget can probably be better described as a let's not really upset too many people budget after last year's backlash from the Coalition's first budget. Some interesting changes in this year's budget though that really coming into play over the next year or two. Some winners and some losers, and just some sort of tidying up measures, and again some things that were announced really before the budget being sort of reinforced. So some of the main ones in this particular budget is the changes to the pension asset test threshold, and what that really means is basically those on with a small amount of assets are going to probably see a small increase in pension, whereas those with medium to larger levels of assets are going to see a reduction in pension income, and that's coming in, proposed to come in from January 2017. The other one has been there's some changes into the aged care means testing. And one of the main issues there is around some of the exemptions from rental income for people who've moved into aged care accommodation but have retained their family home and are renting it out. So again, aged care, one of those areas that's a little bit complex and continually changing, to be honest, so important to look at what those rules are if you're getting into any of those changes. The big one though really is the small business area. There's the number of measures around small business, particularly in the short term, but also some opportunities to recognise some of the constraints probably that small businesses faced. Some tax cuts, businesses with a turnover of less than $2 million, which seems to be the definition these days of a small business. Those businesses are going to receive a 1.5% reduction in their company tax. Whether that ultimately means too much to most small businesses under that size, they're probably going to want to get the money out of their business, so marginal tax rates are still going to apply. So maybe not the massive measure the government's promoting it to be for in a practical sense for too many small businesses, but certainly still a reduction in tax is not a bad start. Probably the big one that's going to play out in the coming weeks up until the end of this financial year and again next financial year is essentially immediate deduction for any expenditure up to $20,000. So that really provides a pretty good incentive for some short-term spend for businesses. Again, most small businesses are not looking to run around and spend a lot anyway, unnecessarily, but if you are looking to upgrade or turn over some business infrastructure, well worth checking out whether this accelerated depreciation essentially is a good idea for you. Some changes to FBT, particularly around some of the entertainment expenses and putting a limit on those. Again, more for the employees than necessarily the businesses. But also it changed the definition of electronic devices. There was an FBT rule that essentially said you could only claim one device per year if they basically did a similar sort of thing. These days with the convergence of technology, that's kind of getting a bit too hard to define, so that limitation is going to be removed. And the other really interesting one is rollover relief. Though, if businesses are set up under a particular structure and have a need to change that, normally there's a trigger of capital gains tax as they move from one structure to another. Government recognising that that's really probably more a standard evolution. Businesses won't actually be realising any money at that point in time and therefore wouldn't have the money to pay tax. It makes sense that they should be able to roll that over. So that's the main issues in terms of small business. So the other interesting one to, I guess, probably more to encourage is sort of startup. There are a couple of changes with respect to businesses doing startups. One is the accelerated write-off of the setup costs. Normally they used to be run over 5 years, whereas now you can write those off in basically in the year of establishment. And the other one was with respect to employee share schemes and changes in that area as well, which make them a bit more attractive to especially startup companies, which tend to use non-cash incentives for people as well. Work-related car expenses is the other thing that's really changed a little bit as well. There's really just a little bit of consolidating some of the ways that can be done. So again, not a massive difference for most people, but worth making sure that that you're claiming under the most appropriate rate going forward. Importantly, this isn't going to affect things like salary sacrifice leasing vehicles. This is really more the cents per kilometre sort of method. So look, as always, there's a bit more detail in it. Have a look at the summary attached as well. And if you've got any questions, as always, give us a call. We'd be more than happy to help.